able to listen to me. And they're not able to listen to me. Hello, Victoria? No response.
Hello, sir.
Yeah, I just wanted to check out my
Yeah.
presentation. When can I do that?
Now you can do that, sir. You can do that now. Ma'am?
Share screen.
Hello, sir. Victoria here. Just put on the video. Sir, Victoria here. You called me.
Yeah, good evening.
Good evening, sir. How are you?
I'm fine.
Okay.
I just wanted to check
Yeah,
few minutes before. Once.
Sir, I'm here. Very nice to see you.
My pleasure.
Not only me, sir. Lot of faculty members are willing to and wishing to see you.
So I'll join you in 2 minutes.
Yes, sir. Yes, sir. Perfect.
So you should tell me when I can begin. Hello?
Yes, sir. Your screen is visible, sir.
Yeah, you must tell me when I should start.
Sure, sir. Sure, sir. Just give us few minutes. We will start, sir. You can stop sharing the screen, sir. We will start in a while.
Good evening to all from Faculty Research Cell Samshodhana, School of Commerce, Jain, Dean to the University, Bangalore. General instructions to the participants. Kindly mute your audio and video. Participants need to be present for the entire session. Participants can post their queries in the chat box by the end of the session. A feedback form will be shared during the session in the chat box and YouTube description box. It should be submitted by the end of each session. We had a great session by Mr. Jade Coates on the topic multidisciplinary approach yesterday to crypto market, which was very well received by the audience. Welcome back to the second day of Global Summit. On behalf of Faculty Research Cell Samshodhana, School of Commerce, Wing of Jain Dean to the University, would like to extend my hearty welcome to the speakers for the day. Let's have a glance about the eminent speakers of 5 days Global Summit. Over to you, Sharmila ma'am.
Megha ma'am, could you please confirm whether my screen is visible?
Yes, ma'am, your screen is visible. It works, ma'am. Even we can hear it. Thank you, Dr. Sharmila. Beware of little expenses. A small leak will sink a great ship. Any perfect budget, financial plan is only effective if it is followed delicately. In the quote, Belgium Franklin emphasized on the little expenses that are nothing but loopholes industries can cost you heavily. Binge spending, irresponsible use of credit card, surmounting debts with heavy interest rate and irregular investing pattern result in financial instability. To be money prudent, it is essential to strictly follow the budget or investment agenda and identify loopholes and avoid all means that conflict with your finance goals or finance stability. Dear participants, we are now moving towards our first session of second day Global Summit, a session on commandments of investment. I request Dr. Aniyarna, Associate Professor, School of Commerce, Jain Dean to the University, to introduce our first speaker for the day, Dr. Prasanna Chandra, a renowned author, professor, and most looked up expert in domain of finance. Over to you, Dr. Arnav.
Thank you, Professor Megha. Good evening to all. It's my privilege and honor to introduce Dr. Prasanna Chandra. Dr. Prasanna Chandra is the Director of Center for Financial Management, Bangalore, a gold medalist throughout his university career. He is an MBA, PhD in Finance. He has over 5 decades of teaching experience in postgraduate and executive education programs. He was a professor of finance at Indian Institute of Management, Bangalore, for over 2 decades. He was a visiting professor of finance at Southern Illinois University, USA, for 2 years. He was appointed as a member of several committees, including the Capital Issues Advisory Committee, the High-Powered Committee on Insurance Sector Reforms, and the SEBI Committee on Derivatives. He has served on the boards of a number of organizations, including Torrent Pharmaceuticals, Power Finance Corporation, UTIIAS, IIMB, SDMIMD, IFCI, Templeton Mutual Fund, Bangalore Stock Exchange Limited, IC5, and Karnataka Soaps and Detergents Limited. He has been a consultant to many organizations. Dr. Chandra has conducted executive seminars for a number of organizations like Tata Motors, TMTC, Infosys, TCS, ITC, Wipro, Hindustan Unilever, Standard Chartered Bank, Saskin Communications, BHEL, Bharat Shell, ANZ, Glaze, HMT, Canara Bank, Vaishya Bank, ONGC, GAIL, Motorola, and Tata Power. He has published 10 books on financial management, theory and practice, behavioral finance, strategic financial management, managing for value creation, projects, planning, analysis, financing, implementation and review, investment game, corporate valuation, finance sense, fundamentals of financial management, and valuation of equity shares, and has authored over 70 articles in professional journals and business periodicals. He has been a Fulbright Scholar and a UNDP Fellow. He has received several honors, including the Best Teacher Award from the Association of Indian Management Schools. A very warm welcome to you, sir. Requesting you to take over this session.
Thank you for your kind introduction. I was asked to speak in this conference, which is focused on global securities market. I decided to talk on.
Excuse me, sir. Your voice is little low. Your voice is little low.
What do we do? Can you hear me?
Yes, sir. Now it's audible.
Okay. Yes. So in this program, this is a kind of an outlier session. I'm not going to speak to you about what is happening in the global securities market. Instead, I decided to talk about what I believe are 7 commandments of investing, which every investor should bear in mind. I've been associated with the investment industry for nearly 5 decades in some capacity or the other. And I realized that most of the investors do much poorer than the markets in which they function. Here is a very simple statement of what has happened to the Indian securities market from 1st April 79 till the end of 2021. Sensex from 100 goes to 60,000. Over a 42-year period, Sensex grew by a factor of 600, providing a return of nearly 16%. If you look at the returns from 1990, they have been about 14%. But I find that most of the investors have earned much lower rates of return because they have committed some mistake or the other. Investors generally tend to underperform the market, and this is based on work done internationally. Here is a very interesting graph from Dalbar Report 2091. Dalbar is a very famous North American organization which looks at how investors have fared vis-a-vis the market. And this is the kind of difference you find. This is not just in India, it is not just the US, it is there almost in every country. There's a huge behavioral gap, and this is attributable to investor folly or investor irrationality. there is a clash between economics of investing and emotions of investing. The economics of investing are very, very uh, healthy, but emotions of investing corrode performance considerably. In this session, I'm going to talk about some of those corrosive influences on investor behavior and suggest a framework which I have found very useful over a period of time. The framework consists of certain commandments which are more or less obvious, but they need to be considered together in order to improve performance. The legendary Benjamin Graham said the investor's chief problem, even his worst enemy, is likely to be himself. So it is not the problem with the market, it's the problem with the investor, and that's the reason why you have such a gap between market return and investor return. The enemy lies within. Investors tend to do poorly because of impatience, overconfidence, chasing trend, greed, fear, envy, boredom, herd instinct, unrealistic expectation, wrong attitude toward profit and loss. In fact, most of the investors make bad choices. In fact, human beings in general are very irrational. There's a very interesting book called Predictably Irrational by Daniel Ariely, in which he says that we are irrational and we are predictably so. The reason is very simple. Our brains are well designed for the environment which our ancestors faced 150,000 years ago in the African savanna, but potentially poorly suited to the industrial age which began 300 years ago, and even more ill-suited for the information age in which we currently live. There is a mismatch between our brain and the environment in which we live, and this mismatch is the reason why we are hardwired to do poorly financially. I'm making a very broad statement because by and large, investors tend to underperform the market in which they function. So they have to follow a set of guidelines if they have to ensure their performance is comparable to what the performance of the market is. And here is a set of 7 simple guidelines. They have to be followed very diligently and religiously if investment performance has to improve. Take charge of your investments. Every person has a number of financial goals. If you have just graduated and you're working, your first priority may be to acquire a car, then get married, buy a house, raise a family, provide for children's education, provide for children's marriage, set up funds for your own venture. If you have entrepreneurial instincts, provide for retirement, contribute to charity, and provide for bequests. These are some of the financial goals. We have to define the goals very clearly and the time frame in which these goals have to be achieved and the quantum of money that is required for fulfilling these goals. They are goal-directed animals, so you have to define your goals very clearly so that you can work toward the achievement of your goals. The objective of investment management is to maximize the probability of achieving your financial goals without exposing yourself to risks that you are uncomfortable with. To start with, you have to prepare your financial scorecard, which shows your income and expenses, your assets, your net worth and liabilities. Every person must prepare a financial scorecard to figure out his or her income, expenses, assets, net worth, and liabilities. And the most important thing is you must be an investor and not a speculator. An investor typically has a planning horizon of 1 year or more. A speculator has a horizon of few minutes to a few days to a few weeks. The risk disposition of an investor is low to moderate. The risk disposition of a speculator is high. Return expectation modest, high. Basis for decision, fundamental analysis, technical analysis, humor. The investor doesn't normally leverage, but the speculator resorts to leveraging. This session is addressed to investors, not speculators. Unfortunately, most people think that they are investors, but when they get into the market, they become speculators. Every investor is unique, and you are unique, and you know your financial blueprint better than anyone else. So you have to develop a plan which is appropriate to your unique circumstances. People vary in terms of age, wealth, income, spending, risk tolerance, investment goals, knowledge of investing, interest in spending time on investing, access to information, and so on. Just as every person has a unique iris or unique fingerprint and a unique DNA, every investor is unique. The investment decisions that you make are influenced by your goals, your investable resources, the investment avenues available to you, and your investment personality. There are a few basics that I want to highlight here. My experience in portfolio management the last 5 decades has taught me a few basic lessons. Less is always more. Simplicity trumps complexity. The conventional gives you much better odds than the exotic. A long-term process is more important compared to short-term outcomes. Perspective is more important than tactics. Start saving early and save regularly. If you look at the results that you achieve over a period of time, they are a function of savings, return, time, and taxes. There is no better way of building your financial wealth and fulfilling your goals other than saving early and saving regularly. This is a very simple statement or table which shows the power of compounding. If you save 10,000 rupees per year for 10 years and you are able to generate a return of 8%, your savings at the end of 10 years would accumulate to 144,870. If you're able to generate a return of 18% because of high skill and or luck, you can increase your wealth to 235,000. If you save regularly just 10,000 rupees for 40 years, even at 8% rate of return, your savings will accumulate to 2,590,000. If you're able to generate a return of 18%, your savings and investments will accumulate to 41,632,000. That's the power of compounding. That is why compounding is considered as the most powerful phenomenon in this world. You can see the effect of compounding in this graph. It tends to accelerate over a period of time. Benjamin Graham says, live well within your means, live well within your means, save where you can, spend where you must. Today I find that people have a lot of temptations. They are constantly bombarded by all kinds of allurements and attractions, and their savings get compromised in some way or the other. I would like everyone to refrain from conspicuous consumption. Conspicuous consumption is consumption when you buy things that you don't need with money that you don't have to impress people that you don't care about. There's an interesting chart provided by psychologist Janet, which shows that the happiness that is generated is not related to money that you spend. You can derive a lot of happiness by spending very little or no money. You don't have to spend a lot of money to derive happiness. Know how various asset classes compare. There are 4 broad asset classes: cash, bonds, stocks, real estate. Cash includes bank deposits, money market instruments, short-term debt schemes. Bonds are longer-term debt instruments. Stocks are equity stocks and real estate. If we look at the return, risk, and convenience characteristics of these asset classes, you find a picture like this. If you are not willing to take risk whatsoever, you'll have to rely entirely on instruments that fall in this category. The thrust of my discussion will be more on bonds and stocks. I assume that everyone will provide for a house in due course of time and maintain a certain liquidity for meeting emergency requirements. This is the history of investment returns globally. Average returns on stocks have been higher than average returns on bonds. Average returns on bonds have been higher than average returns on cash. Volatility of stocks is greater than volatility of bonds, and volatility of bonds is greater than volatility of cash. Volatility of stock returns decreases as the measurement period increases. The third empirical fact is an extremely useful insight for investment planning. While stocks are very risky in the short run, they tend to be much less risky in the long run. That is the import of the statement. Volatility of returns decreases as the measurement period increases. If we look at the range of returns in relation to period of investment, you find that if you are looking at a short period of 1 year, the range of returns can be very wide. But if your holding period goes up to say 15 years or so, range of returns is very, very narrow. While the mean return remains more or less the same, the range diminishes. And this is the important statement. Stocks are very risky in the short run because volatility in the short run is high, but stocks are much less risky in the long run. Focus on asset allocation. Asset allocation decision or the strategic asset mix decision is the most important decision in investment management. There are three levers of investment performance: asset allocation, market timing, security selection. Asset allocation is concerned with the mix of stocks and bonds in the portfolio. Should you have 50% of your financial portfolio in stocks, 50% in bonds, or 75, 25, 25, 75? Market timing is concerned with deviations from the strategic asset allocation to benefit from market fluctuations. Security selection is concerned with selection of individual securities and instruments. The most important decision is the asset allocation decision. Empirical studies have shown that portfolio performance is determined overwhelmingly by asset allocation. Asset allocation accounts for 86% of the performance of a portfolio. But most of the individuals are obsessed with market timing and security selection. I get frequent calls from friends and relatives asking, is it the right time to invest? Is it the right time to exit? Should I buy this stock? Should I buy that stock? Should I buy this mutual fund scheme? So on and so forth. So their attention is focused on things which are very, very minor in nature. What is most important? Asset allocation. In order to determine the right asset allocation, you have to identify the time horizon of your investment and your risk tolerance. Here is a table which I find very useful. It is probably the most useful table that I have come across in the realm of investment management. While I have written a book on investment analysis and portfolio management, close to 900 pages, if I have to single out one exhibit from the book for being with me all the time. It is this exhibit. If you have a high tolerance for risk and a long investment horizon, you can invest almost your entire wealth in equities. On the other hand, if you have low tolerance for risk and you have a short-term horizon, don't invest in equities. The numbers here represent the proportion of your financial wealth that you put in equities. Obviously, the complementary number would be the proportion of wealth put in bonds. So this is the most important table. You know your risk tolerance, you know the time horizon for various goals. So you have to figure out what is the right asset allocation. Once you have determined your asset allocation, half the battle, or I would say 75% of the battle is won. This next principle is diversify. Diversification is only free lunch available in finance and economics. Most of the finance students know that there are two kinds of risk: market risk and unique risk. Market risk is also called as systematic risk, and unique risk is also referred to as unsystematic risk. Unsystematic risk or unique risk can be washed away with diversification. Market risk cannot be washed away. If you have a portfolio of 15 to 20 stocks, you would have washed away most of the unsystematic risk. So everyone who is investing must invest either in mutual fund schemes or create a portfolio which has 10 to 15 stocks. Diversify, diversify, diversify across asset classes, within asset classes, across markets, across time. This is the only free lunch available in finance and economics. Choose mutual funds and stocks sensibly. You can make investments directly by buying individual stocks and bonds, or you can make investments indirectly by participating in mutual fund schemes. Mutual funds offer tremendous advantages. They provide low-cost diversification. They offer tax advantage. They are transparent. They enable you to make regular investments, and they provide you with a lot of psychological comfort. Most of the investors are advised to go through the mutual fund route. They should make regular investments in 2 or 3 mutual fund schemes. There are thousands of schemes available. If you're not sure which one you should invest in, the default option would be an index fund or an exchange traded fund. If you want to invest directly, you have to make sure that you satisfy these conditions. You have interest in investing, you have math skills, you have knowledge of financial history, and you have temperament. I've come across hundreds and hundreds of investors or so-called investors over a period of time. They think they have these skills, but they really do not have these skills. And it is not sufficient that you have one of these skills. You must have all the 4 skills if you want to invest directly. So most of you are well advised to participate in mutual fund schemes. If you are investing on your own, rely on words and numbers and not sounds and sights. Look at the annual report of the company carefully and do your analysis. Don't listen to people, particularly on TV channels, because sounds and sights tend to invoke the reflexive brain. Numbers and words invoke the reflective brain. This is very important. You have to keep yourself away from the distractions in the market. We have no control over whether our stocks or funds we pick will produce superior returns, but you can control the following: your expectations. by setting realistic expectations. The stock market is likely to deliver a return of 12, 13, 14%. Your expectations should be in line with what one can realistically expect from the market. Don't look for a return of 18, 20, 24%. You have many people who promise much higher rates of return and create unrealistic expectations. Your risk. Ask how much you can lose if you are wrong. Your readiness. Make sure you adhere to an investing checklist. Your expenses. Avoid mutual funds with high management fees. Your commissions incurred by trading frequently. Your taxes and your own behavior. Do not forecast stock price. Most of the people want to know what the market is going to do, and you have a lot of agencies which forecast stock prices all the time. Human beings suffer from a malaise called prediction addiction. We predict all the time, even though the stock market is inherently unpredictable. I'm making a very broad statement. Empirical evidence in the last 70, 80 years has shown that stock markets behave like a random walk. They are inherently unpredictable. When you look at forecasters, you find that they fall in three categories. Those who do not know. Those who do not know that they do not know. Those who know that they do not know, but pretend that they know. This is the most dangerous category, and most of the experts who come on various TV channels know that they do not know, but they pretend that they know because they have to give an impression of authority. And my experience has been, in the last 50 years, I have not come across even a single person who can forecast stock market movement. Periodically review and rebalance. Let us say you have started your initial investment of a certain amount, say 100 lakh rupees, by investing equally in stocks and bonds. Your strategic asset allocation is 50% in stocks, 50% in bonds. You have to review and rebalance your portfolio at least once in a year. After a year, when you review your portfolio, you find that stocks have appreciated from 50 lakhs to 80 lakhs, whereas bonds have remained stagnant. Since your strategic asset mix is 50-50, you have to rebalance your portfolio at the time of this review. Essentially, your wealth of 130 lakhs at this point of time has to be divided equally between stocks and bonds in line with your strategic asset mix of 50-50. If it is 60-40, 70-30, you will have to rebalance it in line with your target asset mix. Many people are reluctant to do that. Having seen the stock market go up significantly, they feel that it will go further if someone asks them to sell some stocks and put in bonds. They will say you're prematurely terminating the party. The party is just because the market will go up by another 50% this year, so on and so forth, because we tend to extrapolate on the basis of our immediate past experience. This is normal human tendency. If you religiously do that, and your portfolio of 130 lakhs is now divided between stocks and bonds equally, at the end of second year, when you review, you may find that stocks have declined from 65 to 70. Bonds have mildly appreciated to 70, 60. At this point, your wealth is 120 lakhs, so you need to equally invest in stocks and bonds. You'll have to sell some bonds and buy some stocks, but very few people do that. Having seen these stocks decline, they are scared. Fear and greed are two emotions which are deeply embedded in our brain. As I said, these are emotions which are hardwired in our brain, and these emotions served a very useful function in our African savanna days, but they guide us in our financial markets, and we tend to be fearful when we ought to be somewhat bold, and we tend to be greedy when we ought to be somewhat fearful. If I have to summarize what I have said, do have a long-term investment plan, 50-50, 70-30, 75-25, whatever. Do automate your savings. Do rebalance your portfolio. Don't check your portfolio too frequently. Don't make emotional decisions. Don't trade. Make doing nothing the default option. There is a very fascinating book called Emotional Intelligence, written by an eminent psychologist, Daniel Goleman. The guidelines or commandments that I have discussed are meant to improve your rationality so that your decision making is not corroded by emotion. These are the ways in which we tend to become irrational. As human beings, we are endowed with certain characteristics of mind and behavior that lead to imperfect decisions and even dreadfully serious mistakes. We are often not rational, and we do not act in our own best interest. We overreact to good news as well as bad news. We are impatient. We tend to be over optimistic. We are proud. We are susceptible to hot tip investing. We naively believe in foolproof schemes. We easily succumb to herd mentality. I have seen this over and over in the last 50 years. That is why I am emphasizing the need to check rationality by following these guidelines. Here is an image of Lord Vishnu lying on a serpent floating on a turbulent sea. What do you find when you look at this image? Even though the sea is turbulent and the environment is very volatile, Lord Vishnu is calm, serene, and composed. Your objective as an investor should be to achieve that serenity and composure by following certain goals very religiously over a period of time and by avoiding frequent interaction with the market. You find that Goddess Lakshmi is serving Vishnu. Lakshmi is supposed to be very mobile, but here she is steadfastly serving Lord Vishnu. If I have to find one person who has come close to this kind of serenity in the world of investment, is Warren Buffett. If you look at his investment behavior the last 65 years, you find that he has remained very calm, serene, and composed, and he has displayed very strong contrarian instincts because of the discipline that is exercised. Now, these are the basics: thrift, independence of thought, discipline, rules, realistic expectations, and common sense. If I have to summarize what I have said in just 7 phrases: invest you must. Time is your friend. Impulse is your enemy. Basic arithmetic works. Stick to simplicity. Allocation, rebalancing. Never forget reversions to the mean. What goes up will come the most important guidelines that one should bear in mind in managing one's investment. I am emphasizing this because often, due to the force of emotion or influence, we make wrong decisions, and emotional effects corrode our performance. Let me give you a portrait of an individual investor as developed by a very interesting survey, perception of price movement. Individual investors spot trends and see patterns where they are non-existent. Human beings see order in disorder. Human beings see pattern where none exists. When you look at the stock market chart, you see some pattern because of a desire to see pattern. We naively extrapolate our immediate past performance onto future, perceive likely variation from equity return to be narrow, and we are overconfident in our prediction. We have an inadequate understanding of valuation techniques, and we can't distinguish good companies from good stocks. While managing risk, we are under diversified. The idea of risk defined at portfolio level is alien to us. Finally, we trade impulsively without prior planning, and the trading sentiment trails the market. I'll stop here because you may have some queries. I suggest that you just tell me what the query is. If there is time, I'll answer some of the queries that the participants may have. Hello.
Yes, sir. So we can hear you. There is a question in the chat box, sir, that says that, sir, what is your opinion for newcomers on portals like Small Case that give ready-made portfolios? Is it a better option than buying stocks and mutual funds?
I have not looked at their portfolio. All I am saying is that you have to first determine your asset allocation, take into account your risk tolerance and investment horizon, and diversify adequately at a very low cost. You can do it on your own. The simplest solution is, suppose you want to invest 50% in stocks and 50% in bonds. As far as stocks are concerned, you can go for an index fund or an ETF, or maybe 2 index funds, and that will suffice. And you can do it regularly on a monthly basis. You don't have to go to anyone for advice or anyone to manage your portfolio. Because often I find that investors have their own preferences and predilections, and they may not fully understand what the portal is offering. I have not looked at that portal, but most of these portals are based on the principles that I have talked of.
So there's one more question that says, is it better option to take mutual funds like with SIP so that it is safer, especially in volatile markets?
As I said, very few people have the ability to invest on their own. My guess is hardly 2 to 5 persons have that ability out of 100. Most of the people don't have the ability to invest on their own, but they think that they have that ability, and that's why they do it on their own. But when they do it on their own, they fall victim to all the emotions and impulses that corrode their performance. That's why you find that there's such a huge gap between market return and investor return. So as a guideline, most of you are well advised to go through the mutual fund scheme. Of course, I have friends who say investing through mutual funds is boring. I can perform better on my own. So I have a very simple suggestion. Suppose you have 100 lakhs to invest. To begin with, invest maybe 80 lakhs in mutual fund scheme. You can have a self-managed portfolio of about 20 lakhs or maybe 10 to 15 lakhs. and see how your self-managed portfolio performs over a 3-year period vis-a-vis the mutual fund schemes in which you have invested in. You have to prove to yourself that you can do better than the mutual funds. And that can be done only after you assess your performance over a period of 3 years. If at the end of 3 years you find that you have underperformed the mutual funds, then forget about investing on your own. But if you have outperformed the mutual funds by a significant margin, you can think of changing your profession. You can become a portfolio manager.
So we have a question by Ms. Rachna Saxena. She asked, home loan interest rates are pretty scary and discourages us for buying property on loan. What's your perspective on this, as it
Come
is
again?
a long-term?
Come again.
So Rachna Saxena is asking that home loan interest rates are pretty scary and discourage us from buying property on loan. What's your perspective on this, as it is a long-term investment option?
But currently, the home loan interests are not high at all. If you look at interest on home mortgages, currently we are in a low environment as of now. So how does she say that it? Hello?
Yes, sir. There was a glitch in your voice, but now it's clear.
No, I am saying that her statement that the interest rates are high or scary is not empirically correct.
So she says that at present it is low, but if you look at the total that we pay.
Today, interest rates, if you feel that they are low, lock yourself in a fixed rate mortgage. Be happy with that. This. Any other question?
Yes, sir. We have a question by Satvik S. He is asking, will capital structure of firm impact on investor portfolio?
Capital structure of the firm?
Yes, sir.
You are talking of capital structure of which firm? The capital structure of the firm in which the investor is investing.
Right,
if
sir.
you are directly investing in the equity of a company, obviously whenever you're investing in the equity of a company, you look at the expected return in relation to risk. Other things being equal, if the capital structure is highly levered, then the investment characterized is carrying a higher level of risk. Capital structure is one of the factors that contributes to riskiness of investment. There are several other contributors to risk. Don't look at just one factor. That's why I'm saying when you make investment decisions on your own, you have to look at a number of factors and form a balanced judgment. Capital structure is one of those factors and not a very significant factor in most of the cases.
So we have a question by Bhaskar Rao, and he asked, what about investment in NPS?
In what?
What about investment in NPS?
That's an excellent investment because you have a very low cost of there, because the annual recurring expenses may be less than 6 or 7 basis points. So it's a wonderful option. Everyone who can participate in NPS should do that.
That's all questions we have, sir.
Yes.
That's all we have the questions, sir.
Please go ahead.
Yeah, that was the last question, sir. So thank you, sir, for enlightening us on choosing the right investment technique for mutual funds and making us understand the basic concept. It was quite interesting to know about the categories of forecasters. Your practical explanation of the stocks and bond is very much helpful for us. We hope the 6 simple steps of decision making will guide us to make better decisions in our life. Thank you so much, sir. Thank you so much once again.
Thank you, and wish you all the best. Thank you.
Thank you, sir.
Bye.
Dear participants, the link for the feedback is being posted in the chat box and YouTube description box. You're requested to fill it and submit it immediately. Fortune befriends the bold. Emily Dixon. With this quote, one of the America's most famous poet sums up how being bold can play a big role in achieving fortune, both financially and in life. Ironically, Dixon lived much of her life in isolation as a recluse, but her words and writing have been bold and poignant enough to live on for over 130 years since her death. It's important not to confuse boldness for carelessness or needless risk. 2 things that can quickly drain wealth and do damage to a credit score. Rather, boldness suggests taking real action to achieve your goals instead of passively hoping they will happen. What that action is, earning more income, saving more money, building your credit, is ultimately up to you. I now welcome our second speaker for the day and request Dr. Ani Arnav to introduce Mr. George Littlejohn from London, UK on green finance. Over to you, Dr. Arnav.
Thank you, Professor Megha. It's my pleasure to introduce Mr. George Littlejohn. George Littlejohn completed his MA in economics from University of Edinburgh. He is qualified as a chartered accountant with Pricewaterhouse, started as a financial journalist. He was appointed as the Director of Business Development for CISI in the year 2007, and later he took up the role of Senior Advisor at CISI. He has about 5 decades of experience in the financial services domain. He is also the member of Worshipful Company of International Bankers. Thank you, sir, and request you to take over the session. Over to you, sir.
Dr. Arnav and Dr. Garud, thank you very much for your very warm welcome and introduction. And it's a great honor and pleasure to be with you today. As Dr. Arnav said, my name is George. I am Senior Advisor at the Chartered Institute for Securities and Investment. Senior is because I'm old. I start with one apology, which is that I'm in Wales just now in the west of Britain. And in Wales, we've got, I think it's 18 million sheep, which is 6 times as many people. And I think a million of them are in the field outside me. So if you hear things that sound like sheep in the background, it is indeed sheep. So thank you very much indeed for watching. I'm going to try boldness, which may turn into carelessness, to try to share my slide with you, if I may do that, which I will do by sharing my screen and then getting the right screen up.
Sure.
Dr. Arnav, perhaps you could tell me when I've got this right. Does that look like the right kind of slide?
Yet to come.
Do you have my slide there?
Not yet, sir.
Okay, well, I'm going to try this again. I do apologize. This is when boldness does turn into carelessness. So let me just get out of this. Come back to Zoom. Share this. Oh, screen sharing has failed to start. I wonder, Victoria has got my slides there. I wonder if she can share them, or is that tricky?
Can I request Miss Victoria?
Do I have control at this end that says it won't let me share my slides?
You have that access, sir. You can.
Okay, let me just start again then. So if I share screen,
Yes,
Does
sir.
that?
It's sharing now. Yeah, it's sharing now.
Excellent. So thank you very much. Need apologies for that delay, that carelessness, which was not boldness,
Not a
but
problem. Not a problem.
thank you.
Yeah,
Let me
it's
first of
visible.
all, thank you. Let me first introduce the CISI, the Chartered Institute for Securities and Investment. I think a number of you know us anyway, but essentially we are a professional body. We were 30 years old last month, and we're celebrating our birthday next month. We've been rather delayed by you know what, the virus. We were formerly part of London Stock Exchange Group and we worked very closely with them. When we emerged from them 30 years ago, we had 4,000 members around the world. Now we have about 45,000, many in India, which is a very strong nation for us, and we're proud to have been represented there by some great colleagues for more than a decade. We do what professional bodies do around the world, which is three things. Firstly, we help people entering our profession, which is the securities and investment business, wealth management, investment banking, operations, and so on. Help them when they come from university and increasingly from school, I'm pleased to say, understand what the business is about by giving them an understanding of the knowledge they need to work in our business. Secondly, we give them the skills to apply that knowledge to benefit their clients, their firm, and themselves. And many thousands of young Indians have taken our exams and have prospered in their careers, both with Indian institutions and global institutions throughout India. And we're very proud of that record. And the other aspect of our activity is the role of integrity. We believe that when you're looking after other people's money, acting with integrity is hugely important. Now, I'm going to try to cover rather a wide range in this talk, but it happens to be particularly timely because of two announcements in the past week. One just yesterday from the United Nations panel of scientific experts, and one 2 weeks ago from the US Securities and Exchange Commission. But what I'm going to talk about here is later on is the changing world of corporate and sustainability reporting, which is very important this year and next in the development of green finance for reasons which many of you will know already, but I'll try to explain as we go along. The importance of a development in November at COP26, the launch of GFANS, too many acronyms in this business, but the Global Financial Alliance for Net Zero, and a quick look at some work by the international accountancy bodies, and I am an accountant, and IOSCO, the International Organization of Securities Commissions, to improve information flows. But let me start with those two very important developments in the past 2 weeks. Firstly, as you probably saw just yesterday, the United Nations experts on climate change, the international panel on, my screen is not working again, right, we're now, sorry. Can you see that? Yes. The UN's panel reported that essentially the world was heading for a much bigger rise than is sustainable under any measures when it comes to climate change, that we are heading in the next 3 years for a 3.2 centigrade rise in temperatures by the end of the century unless we take immediate action. This report, yesterday's report, was quite significantly delayed by some severe problems on political problems between some of the biggest fossil share users or producers, and that created tremendous problems. There is a problem here, which is that my signal is declining. Can I just see if I can get a better one? Sorry. I apologize. There is a...
We can hear you, sir. We can hear you.
Yeah, good.
Yes, even the slide is visible, but you have to make it full screen.
Okay, let me do that. Okay.
Yes, it's visible.
Okay, thank you. So big political problems around making this announcement, which delayed it by some days from the biggest fossil fuel producers. You can guess who they are, but particularly those in the Arab world, in China. The Russians did not get involved because they are busy at the moment. And this report essentially gives us much less time than we thought we had even last week to get the climate position right. The other big announcement in recent weeks was 2 weeks ago yesterday, when the Securities and Exchange Commission in the United States changed its rules on disclosure quite substantially. Now, these will face enormous political and legal objections in the US, but they will take place. I've got a warning sign about signal here. Can I just press one button to make this signal work better? Can you forgive me? Then I'll be happier. It's a link through my telephone, and I'm told that if I press a button on my telephone, it will work better. Right, that should be much better. Just coming back to the climate matter and the previous thing, something I should have mentioned before that technological glitch is that in COP26 in November 2021, you all know there was a huge conference in Glasgow, my native Glasgow, in 2021, when world leaders came together and spoke movingly about the dangers of climate change and the need for everyone to pull together to avert them. They then squabbled bitterly about who should do and pay for more of the changes needed to make a transition to net zero by the middle of this century. Some countries inevitably refused to give up coal, and India, huge sympathy to India for not wanting to do so because coal is so important to your economy. But the talks were pulled back on the rails at the last minute, and then the IPCC, the UN experts, gradually reported on some much better thoughts to pull things into real live action. But in one sense, these yesterday's results from the UN scientists rather, are a cause for optimism, because they reiterate the idea that the Paris goals in climate change from 2015 are achievable, albeit difficult to achieve, so long as the right action is taken. But the question, as ever, is whether it will be taken. So coming back to our friends at the SEC in Washington, last week they published these proposals that would force, subject, as I said, to major US political and legal issues, companies to disclose their direct greenhouse gas emissions and have them verified by a third party. Great work, of course, for the auditors. These are long-awaited climate change risk rules, which were proposed by the agency, and they are heavily politically charged. The only Republican member of the Securities Commission actually turned her camera off during the launch of the protest and to cut, she said, her carbon footprint. Now, these changes have been a key plank of the Biden administration's pledge to help limit global warming. The SEC proposal would require companies to publish their direct emissions as well as emissions derived from their electricity needs. Now, these are called Scope 1 and Scope 2 emissions, and these are phrases which I'm sure you have heard. If not, you'll be hearing them very regularly during the course of this year. Essentially, Scope 1 emissions are those that come from your own use of electricity in boilers and in vehicles and ships and so on. Scope 2 is what you buy in from the outside in the form of electricity and gas, etc. It would also, the SEC would also require companies to make an annual disclosure of their plans to reduce emissions and their targets. This is to try to cope with the problems that the scientists at the UN reported on yesterday. The most controversial aspect of the climate risk disclosures are those involving the company's value chain. In other words, its inputs and its outputs, or so-called Scope 3 emissions, the emissions made by the people supplying them, and the emissions made by the products and services that they supply. Now, under the SEC proposal, these would need to be disclosed only if they were deemed to be material, significant enough to report on, or part of the company's own climate targets. They would not be subject to third-party verification because they are very hard to measure and almost impossible to audit, and they'd be protected from legal liabilities. There's essentially a safe harbor rule here. But these rules are important globally, not just in the US, because they're the first set of mandatory disclosures issued by the SEC on climate risk. This announcement also sets up a potential battle between companies and their investors, and that's major global companies, of which there are so many to be proud of in India, and the investors who've complained about a lack of consistency in reporting and standards and transparency over environmental damage. It's very hard to measure who is responsible for much of the climate damage happening right now, which is affecting all of us. But as I said, there's going to be huge opposition to what the SEC plans. In an effort to combat greenwashing. I'll come back to greenwashing in a minute, but essentially companies and investment firms making items of their product base, which are not actually green at all, look like green products by dressing up the marketing. Businesses that are setting out on transition plans away from carbon emissions will be required by the SEC and by other regulators globally to share the program's details and their metrics and targets. And this guidance is really the latest in a flurry of proposals presented by the SEC under its chairman, Gensler, who's sought to beef up disclosure spanning climate risk and private equity and hedge funds, as well as cybersecurity, with the aim of increasing transparency for investors. But let's come back to other issues here, which are important. I will come back to the vital importance of these disclosure matters shortly. Just last week, another new report, we launched a report from the London Stock Exchange Group, which was a fascinating analysis of what investors around the world want. It was based on interviews with 1,500, 1,500 high net worth individuals and mass wealthy people in 13 countries around the world, including India. And it asked them a number of issues about investment processes and investment desires. And one of the key things was a question about why investors are more willing now to invest in ESG investments, environmental, social, and governance investments. You will all have heard these terms. You know what they mean, but we'll be drilling down to the detail in a moment. And I will happily, Dr. Anand, make this research work available to the people watching this afterwards, if you would like to see the report, which is fascinating. Now, what's actually going to happen in this sector in terms of stopping us getting to those climactic figures that the UN reported on just yesterday, and which would kill many people on the planet, many billions of people on the planet if we reach those levels, and harm the sort of life that we hope to leave with our children and grandchildren? Well, there was a development in Glasgow at COP26, which was 5 months ago, which was, as I mentioned earlier, the launch of GFANZ, the Glasgow Financial Alliance for Net Zero. This group represents not only the bulk of firms holding client assets advised by our CISI members, but also a large proportion of the members by employment and our CISI corporate supporters, many of them in India. GFANZ represents a really significant shift in the way that finance is approaching the climate challenge and global warming. It's a global coalition of leading financial institutions, at present principally from the Western world, but growing steadily in other areas, all of them committed to accelerating and mainstreaming the decarbonization of the world economy and reaching net zero emissions by 2050. And I'm sure you're all aware of that net zero by 2050 target. It's very importantly, it's a practitioner-led forum. So it's not led by NGOs, by pressure groups, by government bodies. It's banks, fund managers, insurance companies, and so on, which is leading it. And it's a forum for financial firms to collaborate on substantive cross-cutting issues that will accelerate the alignment of financing activities with net zero and support efforts by all companies, organizations, and countries to achieve the goals of the 2015 Paris Agreement. GFANZ was actually launched at US President Joe Biden's climate summit in April 21 by Dr. Mark Carney here in the photograph. And as I'm sure you all know, Mark Carney was until 2.5 years ago, governor of the Bank of England, and he then became the UN Special Envoy in Climate and advisor to the British Prime Minister when Britain and Italy were president of COP26 last year. But it was brought to life on Finance Day at COP, the first Wednesday of COP in Glasgow in November. Now, when it was launched, I will confess that last April, at the early launch, a lot of us thought this looked awfully like greenwashing because it seemed to be a lot of very big numbers being added up by American politicians in particular, saying that all of these banks and asset managers and insurers were focused on climate change, which we didn't quite believe. And then when Mark Carney announced it on the 3rd of November and mentioned this figure of $130 trillion, and it's now bigger than that, we thought that all he had done was add up the balance sheets of all the institutions which had nodded their heads saying, yes, we think climate risk is a huge problem and we will work on it. But in fact, What he's done is much more sophisticated and much more clever than that. And essentially, he's in English parlance enabled regulators and governments around the world who deal with these many firms, these many hundreds of firms, to put their feet to the fire, to force them to achieve some pretty detailed commitments that they made. There are 5 or 6 key commitments, and everyone who's signed up for GFANC's membership has agreed to align with the Race to Zero criteria, which are to use science-based guidelines to reach net zero emissions across all emission scopes. That's the 3 I mentioned earlier, by 2050. Very importantly, to set interim targets for 2030, just 7.5 years from now, around the corner, that represent a fair share of the 50% decarbonisation that's needed by the end of this decade. To set and publish a net zero transition strategy, to commit to transparent reporting, which is where the SEC comes in, transparent reporting and accounting on progress against those targets, and to adhere to strict restrictions on the use of offsets, carbon offsets, like, for instance, planting trees because you've just been in a long-haul flight. These will be quite severely restricted under new and changing rules. Here in Wales, we've got huge numbers of rather ugly forests planted by people like me who've flown a lot over the years and assuage our guilt by giving money to airline companies to plant forests, but they are not sound in biodiversity terms, so they will not be, that will not continue in the future. Now, GFANC's achievements have really been quite significant over the past few months. At the end of 2020, the year before last, the only financial alliance in the Race to Zero was the UN-convened Net Zero Asset Owner Alliance, NZAOA. There are too many acronyms in this business, so I'll try to make that the last one I use, so apologies. But at the time, that had 30 members with about $5 trillion in assets, a lot of money, but nothing like what Carney has put together. At the start of 2021, the Net Zero Asset Managers Initiative and the Paris-aligned Investment Initiative were launched. And this was followed by the Net Zero Banking Alliance in April 21, alongside GFANC, providing a vehicle for the banks to make similar net zero commitments in line with the Race to Zero criteria. This momentum has continued to accelerate, and today there are more than 3 more alliances. There's the Net Zero Insurance Alliance, Net Zero Financial Service Providers, and Net Zero Investment Consultants. And the latter 2 were launched with the support of GFANC during Climate Week in New York in September 21. These subsector alliances add important entry routes to GFANC and the Race to Zero for further segments of the financial sector, of course. Now, as of the end of November 21, after COP26, membership of GFANC included almost 500 financial firms from nearly 50 countries, responsible for assets of, at the time, more than $140 trillion. This historic effort brings together a significant and growing proportion of the global financial industry in a common mission to make climate considerations a part of every capital allocation decision. Now, I spoke earlier about the role of practitioners in GFANC. It's led by a principals group of CEOs from member firms, so CEOs of major asset managers, banks, insurance companies, and so on. And these represent very diverse geographies and business models. So it's not an undiverse set of, frankly, white men running this. It's very, very different from that. It is properly diverse and interestingly instructive in the way it operates. This group sets GFANC's strategic direction and priorities, and it monitors progress against them. These priorities are then implemented through a steering group, which comprises senior staff from each firm, represented in the principals group, and from the NGOs that convene GFANC subsector alliances. Now, I said earlier that GFANC wasn't formed of NGOs, non-government organizations, but they take a lot of advice from the very many wise people who work in not-for-profit organizations outside of government and outside of commerce. GFANC has also established an advisory panel to ensure that its work is held to the highest standards of ambition. This is a Mark Carney phrase, to the highest standards of ambition, while keeping climate science at the heart of everything that it does. Panel members are from NGOs representing a variety of technical climate expertise. There's a focus on the financial sector, of course, And the panel's role is to provide strategic and technical advice to GFANZ and to facilitate collaboration between it and the wider sustainable finance ecosystem. Now, following the launch of GFANZ, the principals group moved very swiftly within days to agree on a truly ambitious program of work streams at their first meeting. These streams aim to elevate and build on the rich, very rich body of work that's already been accomplished by the scientific community, by NGOs, by industry groups, and by other alliances. And the work streams are organized to drive the commitment and engagement, investment, and ultimately the alignment required to transition the financial system and global economy to net zero. Each of these work streams is sponsored by one or more of the principals group CEOs and led by a task force of leading industry practitioners who represent 40 or so, maybe 45 institutions from 15 or 16 countries. Now, essentially what these work streams are trying to do is to move the needle in climate change. We haven't got time to take a look at what they all do, but let's take a look at some of them and how they go about effecting change in finance. Now, all these work streams, and there are 7, if I'm counting right, yes, 7, they all incorporate the views of a diverse range of financial sector institutions and geographies from around the world, in other words, banks, asset managers, asset owners, insurers, financial services providers, and advisors from some of the leading technical experts in the world and from universities like your own. They've set ambitious objectives while also recognizing the need for pragmatism and urgency. Looking at the time, let me just look at one of these just now, the first, sectoral pathways. This stream is engaging and working with industries to catalyze, bring together alignment between financial institutions and major global industries on sector-specific pathways to reach net zero emissions. It's developed a framework to articulate the needs and expectations of financial institutions for actionable sectoral pathways, another Carney phrase, actionable sectoral pathways, incorporating work from both financial industry initiatives and sectoral organizations. Over time, there will be more detailed guidance which will be added to the framework to create a resource to help financial institutions evaluate sectoral net zero pathways and to help efforts to develop new pathways. It's specifically tackling hard to abate sectors where tackling the climate challenge is harder than others, and fossil fuels are, of course, at the heart of this. This stream has prioritized 3 sectors for its initial focus: steel, aviation, and oil and gas, all heavy producers and users, respectively, of fossil fuels. And it started working with the real economy on ongoing and planned initiatives in these sectors, building on the large volume of work already being done on this topic. The stream is also considering approaches to responsibly retire carbon-intensive assets in a way that maximizes real-world decarbonization using science-based targets, again stressing the importance of science-based targets in all of the UN's and GFANZ's work in this area. There's also a real desire to avoid, to minimize social and economic damage, the so-called just transition, so that we can't expect people to shut down their coal mines just because we in the Western world don't like coal now. We used to love it, now we don't like it, but we can't expect everyone suddenly to change our views. And this is very important to GFANZ's work in general and Mark Carney's mission in particular. Very good man. Developments in this stream are feeding directly into learnings for the streams on developing real economy and financial institution transition plans. Dr. Chandra spoke wonderfully about fear and greed and about managing portfolios. Let me just talk a little bit here, less wonderfully than Dr. Chandra, about portfolio alignment measurement. What this work stream is about is supporting further development and effective implementation of portfolio alignment metrics so that financial institutions can seek to drive convergence in the way that alignment is measured and disclosed. Again, coming back to the SEC's new rules being developed right now and launched 2 weeks ago. This work stream was established in response to quite rapidly growing investor and lender interest in measuring portfolios alignment to the objectives of the Paris Agreement. and it builds on analysis done by the portfolio alignment team and commissioned by the Task Force on Climate-Related Financial Disclosures, a powerful group under the wings of, again, Dr. Carney and Michael Bloomberg of Bloomberg LLP and former mayor of New York. I think, having said I'd just covered one of these, I think I do have to just mention briefly the role of mobilizing private capital to emerging markets and developing countries. This stream is aimed to support a significant increase in the flow of private capital to emerging markets and developing countries, so that their transition needs through private sector investments and public-private collaboration can be met. Current GFANZ members currently represent at least $7 trillion, probably heading for $8 or $9 trillion of assets in emerging markets and developing countries. But there is significant untapped potential to further finance the transition in those markets, especially through innovative private-public financing partnerships. Dr. Chanda spoke about fear and greed. There is, as there should be, a lot of fear about the impact the climate is having on the world in the short, medium, and long term. But there's a lot of greed as well on the part of bankers and asset managers, that there's a lot of potential for profit to be made in supporting that just transition. And many of them, the more forward-looking, are already doing that. Now, this work stream on emerging markets is committed to working with policymakers to help create a financial architecture that will mobilize far more net zero aligned financial investment into the countries that are most vulnerable to the impacts of climate change, and require financing to help them to transition to a net zero future. The focus is going to be on 4 specific avenues: identifying and scaling existing catalytic initiatives that will catalyze developments and move them forward much more quickly than straightforwardly pouring money into a problem, and that demonstrate strong potential for impact. Impact, very big word in the West just now in terms of what we must do in finance. Good impacts, very good indeed. Supporting the second ambition is to support the development of country platforms that will accelerate the enabling conditions for structuring bankable projects. Thirdly, there's a need to establish a more structured program of engagement with the multilateral development banks and development finance institutions that are key to blended finance projects. And finally, there's a plan to set out a replicable and standardized emerging markets, developing countries specific reporting framework that can track the movement of GFANZ's member assets into these countries and markets. I could go on here forever, but let me just turn to something very important that Mark Carney said at the beginning of 2021 when he was launching his path to COP26 in London's Guildhall. He had just stepped down, or was just about to step down, actually, in 2 days' time as governor of the Bank of England. He was going to be deeply involved in climate, which he still is. And he made this seminal, very important remark that every professional financial decision must be taken with climate change taken into account. Now, this fed straight into something that we, the UK professional bodies, had been doing for 6 months until then, which was building something called the Green Finance Education Charter. This was initially an impossible dream. A wonderful man called Sir Roger Gifford, former Lord Mayor, a Scotsman like me, a banker who sadly died long before his time last summer and is greatly missed. But Sir Roger decided it would be a good idea to get some professional bodies together to work together on the climate challenge, to build our members and our students' knowledge of what has to be done to deal with the climate challenge, to deal with biodiversity, and very importantly, to handle all the rest of the UN Sustainable Development Goals. No time to talk about them right now, sadly, but you know what they are, and very important indeed. Walking into the meeting with Sir Roger, the chief executive, one of the biggest accountancy bodies, and I agreed that getting 2 professional bodies to agree to do something was possible. 3 or more, impossible, wouldn't work. But with a bit of persuasion and banging of heads together, Sir Roger made it work, and we now have 14 member bodies in the Green Finance Education Charter. We have between us more than 1 million members in Britain, 1 million students in Britain, about the same numbers through various linkages overseas. So 2 million fully qualified professionals and 2 million students. Many of them are members, chartered accountants, ACCA members, CFAs in India, are working on this great campaign to bring knowledge together. I said I would talk about accountability and reporting. This is very important, and a great deal of work has been done. I pay great tribute here to one woman, Veronica Poole, Global Head of IFRS at Deloitte. Very, very charming, but very forceful woman. And she decided 3 years ago that the time had come to do something about sustainability reporting for her clients and for the rest of the community. And essentially, Veronica, laid the groundwork for the International Sustainability Standards Board. Now, normally, as you'll be aware, setting any kind of standards in the financial world takes years and decades, but an awful lot of work has gone into the original launch of the ISSB, which essentially happened at COP26 in Glasgow, so that when it started, it was up and running very fast already. And the first standards will appear this year. They are really well developed and will help people rely on the figures produced by corporates in a much better way than they were ever able to do in the past. So very important area. And this particularly feeds into the disclosures required by global regulators like the SEC. The financial services firms are really heavily dependent on the reporting by the corporate world. And historically, these disclosures have been made by companies that focused on financial performance reporting, not on anything to do with sustainability and impact. Over the years, corporate governance codes require that companies make disclosures on non-financial matters like corporate social responsibility, and much more narrative reporting, much more explanation of what they were doing. Then in 2010, very brief history lesson here, we haven't got much time, the International Integrated Reporting Council was launched by the Prince of Wales in Britain and several international partners, including the big 4 global accounting firms. And that reported on how a company's strategy and operations impact the 6 capital stocks that matter greatly to all of us: natural capital, manufactured capital, human capital, social, intellectual, and financial capital. The aim was that companies would report on these, which they are doing increasingly, much more quickly in future under the International Sustainability Standards Board, and that they will, while these are voluntary right now, integrating reporting has been widely adopted, at least in part, by many multinationals, and climate issues were beginning to demand a reset of the whole reporting framework, thus the development of the ISSB. I'm conscious my hosts are probably nodding at me saying, get off the screen and allow for questions. Let me just talk about one brief further area, which is the work of IOSCO, the International Organization of Securities Commissions, which again at COP26 launched the details of a major program looking at the ratings agencies and data providers. Now, we all know about the work of the ratings agencies, Russell, MSCI, smaller ones like Just Capital and so on. The problem with the ESG ratings, particularly in matters to do with green and sustainable finance and climate risk, is that they all measure different things. And so the figures they come up with can't be compared across companies. So for instance, Tesla, we all know about Tesla. On some scores, for instance, it's the S in ESG, Tesla scores very well. It's very good with its workforce. Elon Musk did a terrific thing a month ago by putting a geostationary satellite above Ukraine so that people could have decent access to the internet during the terrible times that they're facing. Environmentally, Tesla is of course sound because it's building electric cars, but what happens to the batteries once the cars have finished their useful lives? And in governance terms, unfortunately, Elon Musk is perhaps not the best example of good governance in the world, but he's a great hero of many people, so I'm not knocking him. Now, some firms like MSCI give him a pretty high rating because of that balancing act, because his S and his E factors are better, but others like Just Capital give him a very poor rating because they regard the governance matters as being terribly important. So what IOSCO is doing is telling the regulators to tell the ratings agencies and data providers to be much more transparent in the way that they do things, so that investors in particular can compare much more directly what individual ratings agencies are doing and therefore what the ratings they produce mean. I think, colleagues in India, if there's going to be time for questions, I should probably stop there. There's much more to be said, but shall I stop and take any questions there might be? Dr. Arnav?
Yes, sir.
So very happy to answer questions, very happy to carry on for a bit if you like, but I've covered a great deal of ground here and very happy, as long as my signal holds, to answer any questions or comments. I'd love to hear any comments that people have. And thank you for listening.
Yes, we have a few questions. I request Professor Megha to take over.
So there are a few questions in the chat box. I'll read out the questions for you. It's by Janet Bindra. She asked, should climate risk, ESG, sustainability be a part of university curriculum?
Well, Mark Carney would say yes, for absolutely certain, that it should be part of professional and university and professional bodies' curricula. To understand what is going on is very important. And one thing I've found about this, I did a little bit of this at university a very, very, very long time ago. And then about 30 years ago, worked on a project with a woman who was, I thought when I met her, she was a Californian hippie because she looked like a Californian hippie, but she had an MBA from Harvard and a PhD from New York State in financial mathematics. And she worked for the Californian State Pension Scheme. And we did a project and wrote a book called The Rewards of Virtue, where we posited the idea that if you invest in a company which is good, which does good by the community and by society, you'll make more money than by investing in bad companies. And we know data to prove that. And while there's now a lot of data which seems to indicate that, there's a real lack of understanding of the linkages between good behavior and good performance, what the causation effect is. And I'm sure there are many of your colleagues watching this who know far more about it than I do, but I do believe that matters to do with sustainability and impact and the specifics of ESG would certainly play a part in any business course, and also frankly any course, because keeping, when Britain ended the First World War 100 or more years ago, there was a campaign here to build homes fit for heroes. Well, Mark Carney says that what we should all be doing now is keeping a world that's fit for our grandchildren to live on. So I think everyone has got a role to play here, whatever they're studying.
So we have a question by Ayush, and he's asking, how can a retail business implement green finance in its work?
Thank you, Ayush. This is a huge question, and it's a very good one. And it's a great opportunity for many retail firms here. Most of the people in most of the asset managers and GFANs run major retail funds, and probably something like, I guess, but 95% of the retail funds out there, certainly in the Western markets, are issued by GFANs members. There are big opportunities. And one good thing about green and sustainable finance is that you don't have to be huge to make it work properly. You can actually be quite a small firm and be quite selective. And this is particularly prevalent in the exchange traded funds market, where you get, for instance, I know two young women who in their late 20s in London, one American, one Italian, who run a great firm running an exchange traded fund on decarbonization projects. So they invest in businesses through an exchange traded fund, an ETF, that simply do decarbonization, and they're making an awful lot of money for their clients. And it's two of them and a secretary, and it's great. So you don't have to be Vanguard or BlackRock, you can do it on your own. So it's a great opportunity for retail as well as capital markets players.
So the next question is from Mr. Ravi Chandran, and he's asking, so is it good to have ISSB, but given the pressure on corporates currently in the US, EU, and Asia, can we not expect a higher level of resistance on this part? These involve cost and capex hard to come by now. How do we address this contradiction?
Okay, very good question and a very good point. I think the issue is that while the causation between investing in a good company, or rather a company being what we might all call a good company, with good environmental scores, good societal scores, good governance scores, the link between that and better share performance is not clear. It's not clear what the causation is. What is clear is that companies with good ESG scores are paying less for capital. So companies that are potentially under threat from the climate challenge are going to start paying more and more for their capital, quite simply having to pay more dividends or more interest on bonds than others. So reporting on good environmental and sustainable behavior, I think, will be avoided will create political problems in many countries, but ultimately the market will decide, and companies which are good will find it easier and cheaper to raise their operating capital.
Thank you, sir. The next question is from Satvik S. Is there any regulatory body for sustainable investment products?
Yes and no. All of the regulators, national regulators, regulate the products. They're not entirely certain that they do it properly, and they're quite open about this because there's so much lack of understanding. That coming back to the first question, which applies to this as well, the market for professionals who know anything about ESG and sustainability is huge. I get probably an email or a call a day from firms asking me if I can recommend something to come and work on sustainability for them. So there's a huge demand for people to understand it, and in regulators as well. The problem regulators face, frankly, is that certainly in markets that I know, developed markets in Europe and North America, the demand amongst the firms is such that they pay better than the regulators. But the Financial Conduct Authority in Britain, for instance, all of the regulators of retail products around the world that we work with, and that's about 50, are involved to a greater or lesser extent in regulating products. Central banks, prudential regulators are deeply involved because they see, in most cases, in every case, major systemic risks if people don't get the climate challenge right. So yes, regulators are heavily involved in it, although they sometimes lack resources because the private sector is sucking up all the skilled people.
Thank you, sir, for all the informative answers. It was a session which gave us a lot of insight about green finance and sustainable investment. Thank you for investing your time and acknowledging us with so many good things. Thank you for your time, sir.
Thank you, Dr. Garud, and thank you all for watching. Thank you very much indeed.
Dear participants, the link for the feedback form is being sent in the chat box and YouTube description box. You're requested to fill it and submit it by the end of the day. On behalf of Faculty Research Cell Samshodhana School of Commerce, Jain Deemed to be University, I deem it my privilege to thank and extend a heartfelt gratitude to the speakers for spending your valuable time and enriching the session and knowledge of the participants. It's me, Dr. Megha Garud, along with Dr. Ani Arnav, signing off as MC for the day. Wish to see you all tomorrow again. Bye, sir.